G'day and thanks again for joining us on the Vantage Point podcast, where we're today fortunate enough to be having Chris Judd, the former AFL Brownlow medalist turned fund manager, on the podcast. Chris is the founder of Cerutty Macro Fund, a high-performing, globally flexible equity strategy which was launched back in 2023. We talk about the journey of building Cerutty from the ground up, which is now delivering standout returns, annualising close to 25%, with over 80% cumulative performance to date. Now, what sets Cerutty apart is its macro-driven approach. Rather than fitting into traditional small or large cap buckets, the fund dynamically allocates capital based on liquidity conditions, focusing on sectors with strong long-term tailwinds. Chris dives into the mindset shift from the elite sport to investing and highlighting how patience, discipline, and the ability to stay rational during volatility are really critical to long-term success. He also unpacks key market themes from gold, energy dynamics to the AI race and the importance of data and power infrastructure. We think it's a fascinating look at high-performance thinking applied to markets and what it takes to win over the long term, and we hope you enjoy. Chris, thanks so much for joining us again. We were just chatting before. July 23 was the last time you were on the podcast. Been a bit of a journey. Have you found having your own fund? Maybe talk to us about Cerutty and the performance to date. Still got the same passion that you had 3 years ago?
Yeah, look, it's been great fun. So I think when we last spoke, we started Cerutty in June 2023, so we're probably a month old or so. So still finding our way. And I guess too, at under 3 years, we're still a relatively new fund, but we've loved it. It's been a great journey. We've got a great investor base that's along for the ride, and returns so far have been really good, sort of annualising just under 25%, cumulative returns a bit over 80%. So it's been a good start, but there's still plenty of work to do.
And maybe just for those who haven't listened to the much listened last episode, just in terms of what the fund's mandate is, doesn't fit your typical small cap bucket or large cap or mid cap.
We invest in long only listed equities, but it's a really broad mandate. So we can invest anywhere in the world. We've never had more than a 10% allocation to overseas equities. So it is largely concentrated in Australia. When liquidity is tight, we increase our exposure to large cap stocks, or if they're small cap stocks, we favour stocks that are producing a lot of cash flow today.
Yep.
And when liquidity is loose, we skew much more towards smaller cap stocks or growth type stocks. And in a normal liquidity environment, our bias is towards Australian small cap stocks, albeit stocks that are in sectors which have long-term secular tailwinds.
And in terms of the sort of macro lead, you talk to, I think it's 12 or 13 different themes that you sort of follow. How much do you stick to that?
Yeah, we do stick to it.
Yep.
I mean, really just because in my previous life as a private investor and since starting the fund, all my best results have just been in companies that have, large macro-thematic tailwinds. So we really try and stick to that. Tom, who's our analyst, does a great job and is really good at bottom-up analysis of individual companies. And every now and then he'll find a company that he loves, and we meet management. Management seem good, but if it just doesn't have that tailwind, we just won't invest in it.
I remember I was probably 3 and a bit years ago, Chiconi's in that private room, you were sort of pitching the fund, and it was sort of made out as if, it's going to be pretty volatile, and maybe that was sort of more of a warning in terms of what's to come. And if you're worried about a down month, don't invest in Cerutty sort of thing. It feels like it's been less. I look at the monthlies, each time they come out, it hasn't been that volatile, but
it's been much less volatile than the average small cap fund. So, all our outperformance has come in down months,
which is pleasing.
Which doesn't it doesn't matter to us where it comes, as long as it comes. But we've been much less volatile than your average small cap fund. But I think the point to ram home to investors is, equities can be volatile at times, and you really want investors that can handle that volatility. Yeah. Over time, stocks follow earnings, and by and large, stocks go up on average. Where people get skinned is when they panic because the headlines look ugly and they sell at the bottom. So, we do try and I guess ram that home to our investor base that if you need this money in 3 months, there'll be better places to park it. Yeah. You should come into this with a 3-year outlook. It's not going to be a straight line. But we think the rewards will be there for people that can wait it out.
And from a sort of investor relations perspective, in terms of actually raising money for the fund, how hard have you found that? Obviously, you've performed well, which helps.
I've actually quite enjoyed it.
Yeah.
Hand on my heart, this will sound like a wank thing to say, I don't have any investors that I really dislike.
Yeah.
And I love talking about stocks. Like, there's not
passion.
many topics I really enjoy talking about. I don't love talking about footy for an extended period of time. I dislike talking about politics. Like, I really enjoy talking about stocks and macroeconomics.
That helps.
And that's really what I do when I raise FUM. We're really true to ourselves. Like, we don't try and tailor when we're trying to raise FUM or get new investors in. We don't try and tailor the presentation based to what we think that investor wants to hear. Because I guess we want people involved that
Just
are aligned
creates issues
with
down
how
the
we
track, right?
invest.
Yeah.
But it's what it has been. It's been a much bigger part of the job than I thought.
Yeah.
As a small fund, when you're the portfolio manager, it's almost a 50-50 split between raising new funds and keeping your investors up to date and actually allocating to stocks, which is, I thought it was going to be 80-20 or something like that.
Sort of what you talk about with ASX listed CEOs as well,
Yeah,
right?
that's right. I mean, we get nervous. There's a lot of CEOs that just say we're just going to run the business and the money will find us, and it just doesn't happen.
No.
Particularly in small cap land, and funds management is the same.
Yeah.
When we first started, I actually remember saying to Tom, like, we'll just nail the investing and the money will find us. It's not finding it.
Nah.
Um,
And in terms of actually tipping over line to launching your own fund, obviously you were investing for 7 or 8 years or much more before that in terms of back in your footy days and whatnot. You talked about the sort of competitive spirit and probably being judged against the peers in terms of fund management space. What was the ultimate sort of tipping point in terms of I actually want to do this?
There's really 3 parts to it. Like Tom, who's our analyst, was working with me in my capacity as a private investor, and he's in his early 20s. He's highly ambitious and really competent. And I was looking at him going,
It's probably not going to hang around.
no, and he shouldn't.
Yeah.
Like, he should be a part of something bigger.
Yeah.
So that was one part of it. I was getting a bit of a chip on my shoulder when people would say, what are you doing with yourself? And I'd say I'm a full-time investor.
Which
And they'd look at me like I was unemployed.
Yeah.
And I didn't want to be the guy surfing around the corner from Bells Beach where the surf competition was, telling people I could be in the comp if I wanted to, but I was just choosing to surf out here because I was a soul surfer. Because you meet those people in your life, and even if they could do it from a skill set point of view, it's the psychology in managing those emotions that is the real skill in allocating capital for other people. And I was also just recollecting, by this stage as a private investor, there are quite a few times you're investing alongside other investors. The most enjoyment I'd had as an investor was when something goes well and you can ring them up and say, how good was that? Or conversely, when something goes terrible and you go, what the hell was that? If you get to 80 and you've got, a chunk of money and no one to ring up and say, remember when, that feels like a bit of a lonely existence. So it was really those 3 things. Then I had a family office from Melbourne appropriate to manage some capital for them, which I initially just said yes to, and I was going to co-invest that alongside my own capital. And then once you work out the costs of, trustee, fund admin, custody, XYZ, it's just brutally expensive, and you either need to do it properly or not at all. So,
and then going back to, I don't know, you're talking about footy and we won't talk about it, but you did your ACL at 31. Your identity is footy. When you sort of stop playing footy, I know obviously Beck's well known and got a profile as well. Did you feel like you sort of were missing an identity at all, or you were sort of confident enough in yourself that you're happy to sort of go by and invest, or was that the point of when you actually started Cerutty?
No, so it was a mix of things. You do miss that sense of identity, and certainly how people look at you. Do you know what I mean? People look at you when you're
been like 15 years, right? Like it's a long period of time, half your life in terms of you're Chris Judd, the footballer.
That's right. So that's a change. What I missed was, I've got a pretty obsessive sort of mind, and from the age of 15. I don't know what percentage you want to put on it. 80% of my brain was just used towards high performance for sport, and where I could get an incremental gain. And one of the things I really missed was when football ended, there was no utility in that anymore. There was no usefulness to that. So then there's this enormous gap in your sort of abstract thinking, daydreaming when you wake up in the morning. And I still remember the first time I listened to a macroeconomics podcast, and that it was just like just almost a sigh of relief.
Rushing back.
Because it was just something that I found fascinatingly interesting. Like I was working as an analyst at a venture capital company at the time. Venture capital investing is fine, but I just never found it that interesting, particularly in Australia where the addressable market's small. The tech is often not nearly as impressive as overseas tech. It was fine, but it just didn't light me up like macroeconomics did. And just to find something where, I could read macroeconomic newsletters for 6-7 hours a day and feel energized. And that was just such a sigh of relief because that felt familiar to training for football, particularly training when you were young and you could do it all. It
almost sounds a bit ridiculous when you're talking about macroeconomic research and news compared to footy filling the void, but that's how your brain works, right?
Yeah, and it's the thing about macroeconomics that I find so interesting, it can explain what's happening in financial markets, but it can explain what you're seeing in the world around you. And to see that crossover, I find really interesting. And there's a nice freedom to not being in football anymore. The groupthink expectations in football are really strong at most clubs. There'll be someone will come in and give a lecture on whatever left wing political issue is being pushed to the players to espouse, and it's just assumed that that's the truth. And these things are always incredibly nuanced. And that ability to explore ideas you don't really get in football. And when you see a player say something that isn't highly predictable, it causes so many headaches for them. When you're a professional athlete, it's almost easy just not to say
not think and say,
So what the outcome of that is when you don't speak clearly what you think for an extended period of time, you actually stop being able to think clearly.
Yeah.
And I was amazed once I stopped football, you would see an issue which is complex and nuanced. And it really took me 18 months to be able to think through it properly because you're just so programming to say the most predictable answer possible so you can get onto training and doing your work.
Focusing on the job at hand.
Yeah, which is one of many reasons why it can be challenging, I think, for players to to move on to the next phase of life because their encouragement to think for themselves is pretty de minimis.
And how do you sort of find I don't know, you talk about the scoreboard, there's day to day and month to month and not so focused on that, but how do you, the difference between footy where, if you have a clanger or if you have a good game, drop mark, et cetera, it's blatant, and it's well defined. You can be, wrong for years, or wrong for months in terms of in a stock that you're actually ultimately right on. How do you sort of calibrate, that sort of frustration in terms of, staying the course and not, getting frustrated?
Yeah, I think the big difference is often in investing, doing nothing is the right thing to do, and it's not a lazy option. Rarely is a professional athlete is doing nothing the right thing to do. So that's different. But there are other patterns that are the same, like the craving for comfort, immediate short-term comfort is a overarching human urge. And you see that play out in professional athletes. When they're running, they feel like they're about to spew, they'll slow down. Some will slow down more than others. On Christmas Day, they might choose not to train. I reckon 99.9% of professional footballers are on social media because it gives them a short-term dopamine hit, yet almost none of them make any material money from it. And the vast majority of them, it's deleterious to performance, but they still do it. So, and investing is the same. The comfort in investing is to sell at the bottom because cash gives people comfort, even though intuitively people know the long-term value of cash drops wildly consistently year after year in terms of its buying power. And stocks over the long term tend to go up, but they're volatile. So we're on the lookout for things that make investors uncomfortable, and we're charging towards some of those opportunities. A lot of funds try and be perfect when they buy a stock. They'll see a potential re-rate coming in 3 months. they'll not want to hurt their performance until then. So they'll try and buy it 2 weeks before that. And sometimes you can't buy it then. We'd prefer to just get set in something we like and wait.
Yeah.
Our fear of missing out on the potential re-rate is greater than our fear of putting with 2 months of almost a cash drag on the portfolio.
And you talked a lot about the sort of lessons of sport and footy into investing. It's similar. What's something that sort of works against you of bringing the sort of sporting mindset or competitive mindset into the investing landscape that you sort of had to again recalibrate?
No, I think it's that urge to want to do stuff. Do you know what I mean? Like
and actually just hold.
That's
goes
right.
through the investment thesis.
Yeah, like in football, if the team's down, you want to go in the middle and win a hardball, or just screw your guts up and push harder. Sometimes that's just not the right thing to do investment wise. And it's a longer term game. It's an infinite game, so you've got to sort of respect that. That ability to just will the team forward and be a part of that. It doesn't really work as well investing, because sometimes the market, we said long-term share prices follow earnings. In the short term, they follow flows and liquidity. And sometimes, those two things are working against each other. You just have to be clear on when the wind's blowing in your face and when it's at your back.
How do you look at the portfolio in terms of, I'm sure you've had some great winners and some losers. How do you sort of manage that in terms of A, selling the winners, and B, those that you've lost money on? Do you have a sort of, not deliberate bias, but you sort of don't want to buy them again, if that makes sense, that you've been burnt there, or are you strong enough to sort of say, that was actually our fault in terms of buying it at the wrong time, or the thesis was wrong and we shouldn't have done that? How do you sort of look at that?
If we've been misled by a management team, then we'll just sell straight away and we'll never invest with that management team again, and that's easy.
Yeah.
We're much more likely to average up than average down. I mean, how quickly we sell, I guess there's a lot of intra-portfolio competition with us. So what that means to us is if something's our favourite stock at this valuation, we want it to be in the top 5 largest positions. We don't want to be sizing number 35 in the portfolio. So whilst we add a new position or exit a new position, I don't know, maybe monthly, but sparingly, we're trading most days to try and get the sizing where we want it to. So that's important for us. And then with respect to selling your winners, we don't like holding stuff that we feel is overpriced, but we don't like selling elite management teams too early because they're hard to find, particularly in smaller cap companies. So we'll allow a little bit of lax there. But if something's expensive and we can't see a reason for a re-rate in the next 6 months, even if we love the management team, we feel it's 50% overpriced, we're going to have to shave some or exit it and potentially buy back later on.
And in terms of sort of the West Coast Carlton parallels of West Coast, you've talked about phenomenal sort of organisation as a whole, and Carlton structure probably wasn't as sound. Sort of a little bit of parallels in terms of joining a large already formed institution in terms of whether it's another fund or otherwise, and compared to setting one up yourself, and it can blow up. There's risks. It's just you and Tom. Obviously, you've got someone else now as well. How do you sort of look at that? Of obviously worked with Tom beforehand, but actually going through the rigmarole of setting up the trustees, it's a lot of work. How do you sort of look at that? Compared to the two.
It's a huge risk setting up your own fund, very public. So, in some ways I've got more to lose than your average fund manager, because if your average investor starts a fund and it fails, then he's embarrassed amongst his immediate contact list and friends who go, Johnny started a fund and it didn't work, boo-hoo Johnny. It would be a newspaper story and people would be elated who didn't like me, who didn't know me. And
what does a footy player know about investing?
That's right. There'd be all that. So I had to sort of decide if I was going to put up with that initially. And I was far more nervous of not doing something I wanted to do because there could be annoying headlines and just having headlines rule what I wouldn't do in life, than the risk of trying it, failing and having, some articles sprouted out around that. So I was sort of clear on that early. And then I love the responsibility. I think individual accountability is such a important thing. and I don't love dual portfolio managers. I just think it's better.
Stress testing.
There's one portfolio manager. It's this guy or girl's fault if it goes tits up. And I think that's a good way to operate. So that's how we operate. You know, at some stage, Tom may have his own fund and he'll do a great job.
Talk to us about the relationship with Tom in terms of like he's a ripping guy.
Tom's great. So everyone loves Tom. He's great. I met him. He was an analyst at a broking firm that I used when COVID hit. They sacked him and I hired him straight away. And I was looking for someone. He's just great. He's really strong in the areas I'm weak in. So he's great with detail, great at building financial models and Excel and a lot of those things, which I find a bit tedious, which allows me to really zero in on sort of macro themes, liquidity measures, and sort of the psychology of managing a different portfolio. So it's been a really good, working relationship so far, and hopefully it'll have many years to come.
And in terms of any blow-ups, like obviously it's a joint investment decision, I assume, in terms of when you pick a stock. How do you sort of go in terms of looking back?
So if the stock loses, it's one of Tom's stock, and if it wins, it's one of my stocks, and people know.
So you're still the boss.
And it'd be funny how often the stocks change that are Tom stocks from
just
day to day.
Flips day to day with the scoreboard.
So other people would find that tiring. I think it's very amusing. But there are some parallels because it's your own business. Culturally, if you were sitting in an office, like we sit opposite each other, we're talking about stocks all day, and there's just banter, like you would banter at a footy club. So I really enjoyed that bit. I think Tom does too.
How would you go by yourself?
Well, I was doing that. So I left a venture capital fund, and at that stage I was investing in listed equities, doing really well, and just thought I should be focusing on this rather than spending most of my week looking at VC deals that I'm not overly interested in. And so then I just rented an office by myself in South Yarra and got going. But it can be a lonely existence.
Yeah, I was going to say.
Like, I don't need a lot of interaction with people. But if you've been sitting at a desk by yourself from 8:30 till 5, like,
and start convincing yourself on
it's just too much. Yeah, it's just too much time in your own head. So that was one of the reasons why I started doing the world-renowned podcast. I did some podcast stuff, and then I did some football media just to interact with people. And that was sort of good fun. But, the idea of having an operating business with 100 staff is horrifying to me. But I still do need and want to work with people, but small groups that are dynamic are sort of what suits my personality.
And in terms of how big you want Cerutty to get to, what's the sort of the sweet spot? Yeah,
I think we're toying with closing it to new investors at 150 mil. So we're currently about 75 mil. And I reckon about
done really well.
Yeah, we have.
Because there was a lot of, I just know from my personal side, people saying to me that they were doubting that you're ever going to be able to get to any sort of scale. And it's sort of a hobby and all the rest of it. But the results speak for themselves.
Yeah, and we're still not there, but we're getting towards, north of 100 mil, it feels like you've got a business. So we're getting there. I think 500 mil is about capacity, but it's a very messy fund to sell. Like if we wanted to optimize management fees, we'd say we're a small cap manager, or we're a growth manager, or we're a value manager, or we're a large cap manager, and the allocators could go, we neatly fit in this bucket or that bucket that we've got money to allocate to. And the issue with that is if you're a growth manager and every 3 years growth shits the bed, you go to the allocator and goes, I hope your value stocks did well. I mean, all my liquid net wealth is in this strategy. My parents have, recently sold their house, have all their wealth full stop in this strategy.
That's a fair bit of pressure.
There's not the luxury for this not to work in. This needs to be able to work in lots of different environments, which doesn't mean it's going to go up every month, but we need that flexibility to change and pivot to what's going to be in vogue in the market, and that's how it's structured. So we think we're optimized for returns, but we're not optimized for management fees.
Question with that, notice in terms of stock picks, the market's a complete disaster at the moment in terms of volatility and the rest of it. What are you sort of looking at in terms of sectors specifically at the moment, and any stocks that you're happy to talk to?
Yeah, so we think, I talked earlier to, in the short term, it's flows and liquidity that moves pricing, and longer term pricing follows earnings. If we were to look at gold, we think gold's moved since the war in Ukraine because $300 billion worth of Russia's FX reserves got sanctioned. And at that time, most sovereigns around the world thought it doesn't make sense for us to store our surplus reserves in US treasuries anymore, because if you have a disagreement with the US, they can be torn up. So there's been an endless bid for gold since then, and we've seen that in the price. Fast forward to this most recent conflict in the Middle East, the urgency of sovereigns around buying gold has decreased, and there's a much bigger urgency around buying oil and securing their energy and increasing their defence spending due to the conflict in the region. And we don't know for a fact, but we suspect you've had sovereign groups selling gold to fund that near term. But nothing we're seeing in the Middle East or the unpredictability of the US president and their foreign policy, that to us still speaks of a massive tailwind for gold once those flows and liquidity measures change. So that's an asset that's been clipped, but we still like. We think many companies in Australia that rely on diesel were starting to be priced that Australia was going to run out of diesel. We don't think that's going to be the case. We've spoken to industry experts. Any of the medium or large mining groups, they've got long-term contracts with BP that we think will be fully fulfilled. We think there's a very small chance that some artisanal miners that don't have those contracts in place may struggle to get some diesel, but we don't think it's going to be a systemic issue. But I think that's starting to be priced in our market.
Yeah.
And it wouldn't surprise me if you had overseas investors going, well, why don't we long US mining companies because they're not going to run out of diesel, and we can short Aussie mining companies because maybe they will. So that's some of the increased pain I think we've seen here this month, which has been far worse than what we've seen in the American markets. In terms of some of the things we like, Vysarn is our biggest holding, which
because you've been there for what, a couple of years?
We started buying them at 17 cents. They're sort of about 80 cents now. And we're not a seller. We'd be closer to a buyer than a seller. If anything, we think, there's a potential re-rate coming through their Vysarn asset management business, Water Corp, which is a part of the government. The WA government has asked for tenders for a significant amount of water in the Pilbara, and we don't think there's many groups that can fulfil that tender. Obviously, Vysarn Asset Management have put forward a tender for that. If that were to come off, and that should be announced within the next 6 weeks or so, that could lead to a huge re-rate. But it also fits into a broader business of, it's not a high intangible asset business. AI is not going to disrupt it. The value Vysarn's services create for their customers is enormous in terms of the iron ore miners that can't mine their deposits without the dewatering services that Vysarn provide. So we like companies that provide a huge amount of value for their customers, where, the price those customers spend is pretty small compared to the value it creates for them.
And the whole AI trade, I've heard you talk about it before, but it continues to transpire, and there's the different types of firms and the like coming. What's your sort of view on that world?
So we think the most interesting way to play AI is in the US electrical grid. China produces twice as much electricity as the US. When you think through that and think how important electricity is for AI development, it's easy to understand why the US has sanctioned chip sales to China, because if they had the same access to the US with chips, then the AI war race is already won. So US electrical grid is a place we think is really interesting to play AI. That's where we think the real bottleneck is. Also in clean data sets, we think is an interesting way to play AI. AI is only as good as the data it uses. And we think synthetic data creates significant problems over time.
So how do you play that in terms of stock specific?
It's hard in Australia. I think if you looked at who's got the most data in Australia, when we looked at it, it's probably Aussie banks and maybe News Corp, and we're not in any of those positions. Overseas Google is the most obvious one. If you look at YouTube, Google search, the amount of data they have is unbelievable. But they've still got 50% of their business being disrupted by AI itself in terms of their search business is now being disrupted. So that's a challenge. So, we're not there either, but that would be an example. But those example of clean data sets we think is interesting. but certainly the US electrical grid, we're playing that through ikeGPS, which is an Australian listed company, which has a hardware software solution that monitors grid poles and other sort of infrastructure assets for US-based utilities. And, we think nuclear power is the only real answer to provide the amount of power that these data centers are going to require going forward.
And I think I asked at the top, but in terms of motivation, how do you go when markets are shitty? Does it sort of go the other way in terms of being more motivated and got to sort of claw it back and protect capital, or sort of I've spoken to a lot of fund managers that are pretty beaten down at the moment.
It just reminds me of football this bit. I know it can be a bit corny bringing the sporting analogy, but like the players and teams I always respected the most were the ones that played well when the going was tough and played well against good teams. And it's surprisingly easy. Like most players in the AFL can have one huge game. They just get up, they feel good, just things work for them. They kick 4 goals and have a huge game. Most guys will do that at some stage. What's way more impressive is when someone wakes up and they're injured and they have a local and they get out there and they're being tagged and they still produce a solid game. Like they're the players that you end up really wanting to play with and that you really respect. And, investing's a bit the same. There's that saying that you're only as good as your last crisis. And I think that's sort of the same. When liquidity's pumping in and everything's ripping, everyone feels clever and smug. That ability to think clearly when the volatility's around, essentially that's what you get paid for as a professional investor. And we're really conscious of that.
You've done extremely well. Well done, Chris, and looking forward to the next 3 years.
Thanks, Simon.
Cheers.